Hey, what's up guys? This is Daniel Lopez with Invest in You Finance, and today we're going to be talking about short-term capital gains and long-term capital gains. The reason why short-term capital gains and long-term capital gains are important is because when you buy an investment and it's time to sell the investment, you want to know exactly the date that you purchased it, because if you've held that stock for over a year, you're going to be taxed at a long-term capital gains rate tax. And typically, long-term capital gains tax is a lot lower than short-term capital gains. Short-term capital gains is if you've bought a stock and sold it within the year, meaning you did not hold that stock for over a year. And when you sell the stock, you're going to be taxed at short-term capital gains. Short-term capital gains rate is the same as your income rate. And remember, I have a video out there showing you guys how taxes are calculated. So go check that video out, and that way you can learn how your taxes are calculated based on your income. Well, for example, guys, let's pretend that we bought GameStop and we made $3,000. Let's say we invested $1,000, and when we sold GameStop, it was at $4,000. So we made a $3,000 gain. Well, now let's look at when we sold the stock. So we made $3,000. That's great. But now, is that going to be taxed at short-term capital gains, or is it going to be taxed at long-term capital gains? And this is why it's important to know if you've held that stock for longer than a year or not. That $3,000 is going to be just added to your income if you sold it within a year. So let's pretend that you work at your normal corporate job and your salary is $50,000. That year, you're going to be paying taxes on the $50,000 plus the $3,000 gain that you made from GameStop. And then however your taxes are calculated, that's how much taxes you're going to pay on that $3,000. It's just going to be added on top of the $50,000 you already made for that year. But now let's say that you held GameStop for over a year and you're going to be charged that long-term capital gains tax rate. That tax rate is going to be a lot lower than short-term capital gains, because whenever you have a taxable income from $0 to $40,000, you're taxed at 0%. But anything over $40,000 to, I believe it's $441,000, you're going to be taxed at a 15% tax rate. So it just depends on where you're going to fall under that tax bracket. So for instance, that $3,000 is going to be taxed at 15%, which could or could not be lower than your taxable income. So if you made $100,000, that $3,000 gain is going to be $103,000. So your tax rate is going to be a lot higher than someone who made $50,000 and made $3,000 in return for buying that GameStop. So remember, it's very important to know exactly when you bought the stock and when you sold it. I'm going to show you guys a calculator because I love doing the calculations, because if you really want to learn, if you're really trying to become financially independent, if you're really just trying to learn about money in general, it's important just to know the basics of your taxes. And it's just important to just calculate, okay, how much did I make this year minus the standard deduction, and then was my stock investment a short-term capital gain or a long-term capital gain? And these are things that I like to do for myself. I like to calculate what is the amount of money I'm going to owe on taxes. That's very important whenever you want to keep the most amount of money in your pocket. So guys, I'm going to show you guys this calculator. Check it out. I like to use H&R Block. It's a very simple calculator. I'm not being paid for advertising for H&R Block, but this is just a tax calculator. Whoever you want to do your taxes is up to you. I highly recommend you get a good CPA, because a good CPA will save you a lot of money if your taxes are complicated. If they're not too complicated, chances are you could probably just do them yourself with any of the tax softwares out there. Okay guys, let's check out the calculator and see what we will owe on this stock that we made money in. And I'm gonna do some different scenarios and we can see what the difference is between someone who is a high income earner and someone who's a low income average earner. Because remember, if you make less money, then you're gonna pay less taxes. And just remember guys, I like to invest for the long term, because investing in the long term means that it gives time for your money to grow. On average, the S&P 500 index fund returns 7 to 10%. Now, if you do this for a long time, your money is just going to keep compounding, especially if you contribute every week or every month. Just a certain amount every year can bring you in a lot of money in the long term. So guys, I have another video out there. Go check it out. I show you guys how much you need to invest every month just in a simple index fund, and it'll give you $1 million. Go check that video out, guys. Okay, now let's check out the calculator. Let's roll the clip.
I like to use the H&R Block tax calculator that estimates what your refund's going to be. So simply, we're going to pretend that we're single and we're not filing as a married couple. We're not the head of household. I'll just put my age, I'm 34. And I'm going to put I didn't receive any stimulus payments. I don't have my W-2 on hand. And we're going to put that we made $50,000 as our income. Just for this simple calculation, I'm going to put that we have not paid any federal taxes as well, so we can see exactly how much we're going to owe. Right here, you're going to want to click on investments, and we're going to say that we made a profit of $3,000. And we're going to skip this. This is for dividend income. And we're going to say that we held the stock for less than a year. So this is a short-term capital gain. And then we can see how much we are going to owe on our taxes. And we're going to put none apply. And the reason we're doing this is because we just want to see how much we owe in taxes. So our total wages are $50,000. And our investments are $3,000 in short-term capital gains. And our estimated tax that we're going to owe is $2,922. So our taxable income is $40,600 because they subtracted the standard deduction of $12,400. So this is just an estimation of how much we would owe if we had a $3,000 short-term capital gain and we made $50,000. And the reason I want to do this is to compare. Now, what if we had a long-term capital gain of $3,000, meaning we held that investment for over a year? Our taxes are going to be reduced. And I just want you guys to know this. In case you're going to sell, make sure that you're going to sell. If you're close to being over a year, just wait until the year is over. So now we're going to pay $2,605. And this comes out to be around $317 less if we held the investment for longer than a year on this long-term versus short-term capital gains. And that's almost 10% of the amount of money that you made. Now let's see how much someone who makes $100,000 is going to pay in taxes if they have a short-term capital gains of $3,000. remember it's going to be the $100,000 minus the standard deduction, and then they're going to add the $3,000 to your income, because short-term capital gains just get added to your income. So if you made $100,000, you're going to owe $15,824. Your taxable income is $90,600 because they subtracted the standard deduction. And then this is how much you'll owe for a short-term capital gains. Now let's look at if you had a long-term capital gain of $3,000. And you could see the difference between someone who makes $50,000 versus someone who makes $100,000. That's why I say it's very important to reduce your taxable income if you're making a high income. So now, as a long-term capital gains, you're going to owe $15,554. And that comes out to be around $260 difference compared to if you had a short-term capital gain.
Now that you guys know how to calculate your short-term capital gains versus your long-term capital gains, you can decide when you want to sell your investments based on that knowledge. Because if you did not hold that investment for over a year, you're going to be taxed at short-term capital gains. But if you held it for longer than a year, you're going to be taxed at long-term capital gains. But it's always important to look at the calculator, because with the calculator, you're able to figure out the exact amount on what you'll be able to owe. So maybe selling it within a year is okay because you know the amount that you're going to pay, compared to if you held it a little bit longer, maybe you won't have as much income that year, so it's okay to get taxed at the long-term capital gains. It just depends on the situation, but now you have the knowledge to use a calculator and decide on what you want to do. Like always, guys, remember, I'm not a professional tax advisor. I'm not a CPA. Please consult with your professionals. I'm just doing this video for entertainment purposes only, and I'm just trying to share with you guys what I've done and what's helped me out to become financially independent. Like always, guys, please smash the like button. Please subscribe. I'm coming out with these videos. I'm trying to show you guys exactly what I've done and what I've learned to get to where I'm at today, and that is my financial independence. I want you to become financially independent, and I appreciate you guys for just watching the video. Please smash the like button, and please subscribe. Thanks, guys. Take care. Bye-bye.